Before you even think about filing your taxes in 2026, stop, take a deep breath. Because what I'm about to share could be the most profitable information you hear all year. Most small business owners, freelancers, and self-employed professionals are on the verge of leaving a staggering amount of money on the table. We're not talking about a few dollars here and there. We're talking about $5,000, $10,000, even $40,000 in overpaid taxes. This isn't because they're trying to cheat the system. It's because the system is complex, and they simply don't know about the powerful, legitimate deductions they are fully entitled to claim. Think about it. What could you do with an extra $10,000? That could be the down payment on a new work vehicle, a significant investment in marketing to attract more clients, or simply a well-deserved family vacation you've been putting off. It's your money, and you've earned it. Now, here's the urgent truth you need to understand as we head towards 2026. The landscape is shifting, and not in your favor if you're unprepared. First, the IRS is increasing audits in 2026. With a budget boost and a focus on small businesses and high earners, the chances of your return getting a second look are higher than ever. An audit is not just a headache, it's a time-consuming and expensive process you want to avoid at all costs. Second, many of the generous tax breaks we saw from 2020 to 2025 are expiring. The tax code is reverting to stricter pre-pandemic rules, which means deductions that you might have taken for granted are disappearing. And third, the rules are getting tighter and more complex, especially for those operating as an LLC or an S-Corp. The goalposts are moving, and what was compliant last year might not be this year. But here's the good news. This isn't a reason to panic. It's a reason to get smart. Because if you understand the right deductions, the ones that are baked into the tax code for entrepreneurs like you, the entire picture changes. You can legally and ethically reduce your taxable income, which directly lowers your tax bill. You can bulletproof your business from audits by keeping meticulous records of legitimate expenses. And most importantly, you can keep thousands or even tens of thousands more of your hard-earned money right where it belongs, in your pocket. For example, did you know that by properly documenting your home office, a freelance consultant could deduct over $5,000 a year? Or that a real estate agent using the standard mileage rate could write off more than $8,000 in vehicle expenses? These aren't loopholes. They are strategic, IRS-approved methods. Today I'm going to pull back the curtain and show you the most powerful, most overlooked, and most profitable deductions available to you. These are the exact same strategies I use to save my clients thousands upon thousands of dollars every single year at my firm, Finan & Tax LLC. This isn't just for one type of business owner. If you're self-employed, if you run an LLC or S-Corp, if you drive for Uber or Lyft, run a daycare from your home, operate a trucking business, provide home care services, or sell products through an online store, this video is specifically designed to change how you approach your taxes in 2026 and beyond. So before the stress of tax season arrives and catches you by surprise, let me give you the playbook. Let me show you the deductions the IRS fully allows, but that almost nobody uses to their full potential. This is your opportunity to get ahead of the game. Let's get started. Welcome back to the channel. I'm Finantax Clips, helping small business owners save money, reduce tax liability, and stay compliant. Today, we're breaking down the top small business tax deductions for 2026, including new updates coming from the IRS, powerful strategies for LLC S-Corp owners, and the deductions most business owners forget to take. Let's get started. The year 2026 is shaping up to be a pivotal moment for your finances, and it's all because of a major event on the legislative calendar. Many of the significant tax breaks introduced by the Tax Cuts and Jobs Act of 2017, or TCJA, are set to expire. This isn't just a minor adjustment. It's a sunset provision that could revert our tax code back to pre-2018 rules, impacting nearly every taxpayer. For individuals, this means the nearly doubled standard deduction could be cut in half, and the $10,000 cap on state and local tax deductions, known as the SALT cap, might be removed. But for small business owners, the stakes are even higher. While Congress could act to extend these provisions, smart entrepreneurs are planning for the changes now. Let's break down what matters most for your business. First, and arguably most important, is the potential elimination of the 20% qualified business income, or QBI deduction. This has been a game-changer for pass-through entities like sole proprietorships, S-corp, and partnerships, allowing them to deduct up to 20% of their business income. If the TCJA sunsets, this deduction vanishes completely. For a business with $100,000 in qualified income, that's a potential $20,000 deduction gone overnight, leading to a significantly higher tax bill. This affects everyone, but especially those in specified service trades or businesses like consultants, doctors, and lawyers who already face income limitations for the deduction. Without an extension from Congress, this valuable tax break disappears for all pass-through businesses, regardless of their industry or income level. Second, let's talk about how you write off large purchases. We're seeing major adjustments to bonus depreciation and Section 179. Bonus depreciation, which allowed you to deduct 100% of the cost of eligible assets in the first year, is already phasing out. It dropped to 80% in 2023, 60% in 2024, and will continue to decrease to 40% in 2025 and 20% in 2026 before disappearing. Thankfully, Section 179 is still a powerful tool. It allows you to expense the full cost of qualifying equipment up to a certain limit, which is over $1 million and indexed for inflation. Here's a simple example. Say you buy a $50,000 piece of equipment in 2025. With 40% bonus depreciation, you could deduct $20,000 immediately. But with Section 179, you could potentially deduct the entire $50,000. The key takeaway is that strategic planning around asset purchases is becoming more critical than ever. Finally, prepare for increased scrutiny. The IRS is using its expanded budget and 87,000 new personnel to ramp up enforcement, and they've explicitly stated a focus on high-income earners and complex business structures. Small businesses, particularly those with significant cash transactions or those that blur the lines between personal and business expenses, will be under the microscope. This means meticulous record-keeping isn't just good practice anymore, it's your primary line of defense. Now is the time to ensure your bookkeeping is flawless and that every deduction is well documented. All right, let's dive into the top 10 deductions that every small business owner needs to have on their radar for 2026. These aren't obscure loopholes. They are the fundamental, high-impact write-offs that form the bedrock of a smart tax strategy. Mastering these deductions is what consistently saves my clients thousands, sometimes tens of thousands, of dollars every single year. Getting these right is non-negotiable for maximizing your take-home pay. We'll start with one of the most common, the home office. If you run your business from a space in your home, you likely qualify for the home office deduction. But did you know there are two ways to claim it? The first is the simplified method. It's easy. You just take a standard deduction of $5 per square foot for up to 300 square feet of office space. That's a maximum deduction of $2,500. It's simple, requires minimal records, but you might be leaving money on the table. The second, and often more valuable, is the regular method. This is where you calculate the percentage of your home used exclusively for business. For example, if your office is 200 square feet and your home is 2,000, your business use is 10%, you can then deduct that percentage of your actual home expenses. This includes a portion of your rent or mortgage interest, utilities like electricity and heat, internet bill, property taxes, homeowners insurance, HOA fees, and even repairs that benefit the entire home. For many, this method results in a much larger deduction than the simplified option. Next up, your business vehicle. This is one of the biggest tax-saving tools at your disposal. Again, you have a choice between two methods. The standard mileage rate lets you deduct a set amount for every business mile you drive, which the IRS adjusts annually. It's straightforward and includes a factor for depreciation. Alternatively, you can use the actual expense method. Here you track and deduct all the real costs of operating your vehicle for business, including gas and oil, insurance, repairs and maintenance, lease payments, and depreciation. Which is better? It depends. If you have a newer, more expensive vehicle or high maintenance costs, the actual expense method often yields a bigger deduction. But no matter which you choose, in 2026, meticulous record keeping is absolutely critical. The IRS is strict here. Without a contemporaneous mileage log detailing the date, purpose, and mileage of each business trip, your deduction can be completely denied in an audit. I strongly recommend using a GPS-enabled mileage tracking app to make this effortless. Number 3 is equipment and asset purchases. Thanks to Section 179, you can often deduct the full purchase price of qualifying business equipment in the year you buy it, rather than depreciating it over several years. This includes computers, office furniture, machinery, and even certain vehicles. That's right. A heavy SUV, pickup, or van with a gross vehicle weight rating over 6,000 pounds can qualify for a significant immediate write-off. Imagine buying a $70,000 piece of machinery. Section 179 could allow you to deduct that entire amount from your business income right away, providing a massive immediate tax benefit. Health insurance premiums are a huge expense, but they're also a fantastic deduction. If you're self-employed, you can generally deduct the premiums you pay for medical, dental, and vision insurance for yourself, your spouse, and your dependents. This also includes what you pay for COBRA coverage. Plus, you can deduct contributions to a health savings account, or HSA. This deduction is especially powerful if you have a family plan, as the premiums can be substantial. One key rule for S-Corp owners: the company must pay the premium and include it on your W-2 for you to be able to deduct it on your personal return. Don't just save for retirement. Use it to slash your tax bill today. Retirement plans are a win-win, letting you reduce your taxable income while building future wealth. For small businesses, the best options are typically a solo 401k, a SEP IRA, or a simple IRA. A solo 401k is a powerhouse. It allows you to contribute as both the employee and the employer. As the employee, you can contribute up to $23,000 in 2024. Then, as the employer, you can contribute up to 25% of your compensation. Combined, this allows you to potentially save over $69,000 per year, all tax deductible. Business travel is 100% deductible, as long as the trip is ordinary, necessary, and away from your tax home overnight. This includes your airfare, lodging, rental cars, and other incidentals. Business meals are also deductible, but typically only at 50% of the cost. This applies whether you're dining with a client, rewarding your team, or eating alone while traveling for business. Just be sure to document the business purpose. In our digital world, software and subscriptions are a major and fully deductible expense. Think about your entire tech stack. Accounting software like QuickBooks, tax software like TurboTax, creative tools like Canva or the Adobe Suite, video tools like InVideo, communication platforms like Zoom, and even subscriptions to AI tools that boost your productivity. Don't forget website hosting and your email marketing service. These add up quickly. If you have help, their compensation is a core deduction. This includes gross wages paid to employees, payments to independent contractors reported on Form 1099 NEC, the employer's share of payroll taxes, and contributions to employee benefits like health insurance or retirement plans. Finally, investing in yourself is deductible. The cost of education and training that maintains or improves the skills required for your business is deductible. This covers industry conferences, professional certifications, continuing education units, online courses, and relevant books or trade publications. The biggest refunds come from Vehicle plus Section 179, Home Office plus Utilities, S-Corp salary strategy, retirement contributions, depreciation, business travel. If you combine these correctly, many of my clients save between $8,000 and $40,000 every year. If you want your 2026 tax strategy prepared professionally, contact me at Finan and Tax LLC. I help individuals, LLCs, S-Corp, caregivers, truck drivers, child care centers, and small businesses save as much as legally possible. Subscribe, like the video, comment your business type below. See you in the next video.